Hello and welcome to the market update for Tuesday, March the 16th. We've kind of got a flip-flop today with the Dow being down and the Nasdaq being up. Again, we've had these mixed market conditions for most of last week. Last week it was the Dow that was leading higher, and the Nasdaq that was dropping. And typically when you have fractured markets like that, it's usually a bearish sign, but it doesn't always mean that bearish move happens immediately, and that's something I'll talk about today when we look at the charts. Last week I talked about how with the Nasdaq chart being broken it wasn't likely that we'd see the Nasdaq go to a new all-time high, even though the S&P and the Dow and the Russell 2000 hit new all-time highs last week. But it's always possible, and you never know if the fact that the Nasdaq is lagging, if that's it's kind of foreshadowing a drop, meaning it may not happen immediately. So what I would assume is if the Nasdaq does rally from here and does go to a new all-time high, that it probably is a short time after that we get a pretty good sized correction. And that the fact that the Nasdaq was lagging so much and underperforming so much, the last couple of weeks was an early warning sign of that. But it doesn't. It could just drop from here, and it could be that it was showing the same thing. It just happened sooner. So, that's the thing. There's things we can read on the charts. There's warnings we can read on the charts, but we don't always know the timing of it. We don't know if it's immediate or if it could be down the road a little bit. But these are definitely warning signs I'm pointing out because we have to pay attention to them to make our trading decisions. And this definitely isn't a market environment where I'd want to be loading up on a lot of new trades. Because the fact of just the way those indexes are behaving, it's a time to be more cautious and more defensive, and that's what I'm doing right now. As far as the direction alerts, we're definitely not in an overbought condition yet. We're getting close, though. The momentum indicator is to the right side of the buy box right there. It's close to getting into that extreme range. And then you have the breadth indicator, same thing. It's on the far right side of the high level, close to getting into the extreme range. And then you have sentiment, which is not as close to getting into the extreme range, but it is in the high range. So there's definitely some complacency in the market. The buy-sell ratios, we're starting to see that gap widening a little bit. Although, as you can see, we have been a little bit more extreme in the past, so that it's possible that definitely possible if the Nasdaq is going to rally to a new all-time high, that this would get stretched a little bit further, because you have all those tech stocks that have probably moved from buy to hold, and would go back to buy, which would cause that ratio to increase. And then the sentiment is getting close to an extreme, but it's still a little ways away from there. It would definitely push into there, though, if we ended up getting a NASDAQ rally. Now, another thing that I don't trust with the rally over the last week, we can look at it when we pull up the chart, is that, in fact, let's go right to the chart here, is that the volume has basically, well, aside from yesterday, the volume had been decreasing each day for like the last six trading days. So you're having this rally happen on lighter and lighter and lighter volume. Now that usually is what happens. You see that a lot happening when you have a drop. You'll get a drop, and then you kind of get that corrective move back up, that little ABC pattern, and it rallies on lighter volume, and then it follows with another move down. Now the difference here is that we're actually breaking out and going higher, but that's just kind of a warning sign that tells you the breakout isn't very strong. You've broken out. That should excite the buyers when you break out. I love buying breakouts, and yet you're breaking out on lighter and lighter volume. That's usually a warning sign not to trust that breakout. Now, again, with everything I talked about, things could change immediately. If there's news that comes out that excites the buyers, and you see the volume pick up and the market move higher, then that's a good sign. You do want to trade that if you see that type of behavior. And if I were to chase this rally, I'd want to see a lot heavier volume start coming in to show me that there's other buyers that are excited out there, and it may be they're waiting for some sort of a trigger. Now, this week it could be something with the Fed. The Fed is meeting today. They'll have their announcement on interest rates tomorrow. They're not going to raise interest rates. At least that would be a shock. That would really cause the market to freak out if they raise interest rates. But the market will be listening to the language and how, are they talking about getting closer to being open to raising interest rates? The last couple, or I can't remember if it was this last Fed meeting or the one before, Chairman Powell said, we're not even thinking about raising rates, trying to really assure the market that it's just not even being considered. Well, does he come out and say, we're kind of thinking about, this is the weird thing about the Fed, and the way the market just focuses on every single word, and even the tone in their voice as they say a word. It can react in a big way, and that's why I don't bother trying to figure out. I don't even listen to those speeches half the time, or those announcements half the time. I look at the market reaction to it, because to me it doesn't matter what they say, because I can't figure out how to take their words, and I really don't care as a trend trader trying to guess what their words mean. I let the market guess what their words mean, and then whatever it reacts or whatever it does, and I try to follow it. But that could be something that ends up being a trigger this week, and that'll happen tomorrow. And maybe that's why we're seeing some lighter volume. Maybe traders don't want to get too exposed until they hear from the Fed and make sure that the rates aren't going to be rising. Although this is the double-edged sword, though, that if there's inflation in the economy, the way you have to combat it is through raising rates. So it's the market doesn't like higher rates, but you can't have high runaway inflation either. So that's kind of what's going to be tricky over these next few Fed meetings, is to how they kind of maneuver through all that in making those decisions. But that's what worries me, though, is that either one is a negative for the market, or could be considered a negative for the market. And in either one of those seems inevitable, because obviously with all this money that's being thrown at the economy, there's going to be inflation show up somewhere, and when it does, the market's going to have a negative reaction to it. Now, there was a little bit higher volume yesterday, but just barely. I mean, it didn't even get above the volume that we saw on Friday. And then today's volume is going to be lower. It looks like it's going to be lower than yesterday as well. And so those are just little clues, but they're little things that you have to pay attention to, and that's why we're pointing them out, so you can learn how to watch for some of those things as well. And we'll see how it plays out. Sometimes, and this is where you got to be careful about getting too dug in with your view of the market. Getting too bullish or too bearish is it's real easy to see what you want to see, and it's real easy to dismiss little clues. It's real easy to say, well, yeah, it's lighter volume, but we're going higher. That's going to change when these buyers realize how great things are going to be in the next few months. They're going to pour in here, and so I'm going to jump in with everything I got right now. And that's not what the clues are showing right now. The clues with again, the divergence with the Nasdaq 100, the lighter volume on the rally. I want to be able to recognize those little clues in order to protect my portfolio, or to or to make decisions related to my portfolio, whether it be tighten up stops, buy protective puts, trim positions, take some profits off the table, things like that. All right. But here's the Dow. I pointed this out last week. We've been for the last couple of trading days. We've been at the far right side of the extreme reversal risk range. So it's not too surprising that we're down today. Now, being down on light volume is actually a pretty good sign that there's not heavy selling going on yet. But and it could just be that there's a little bit of sector rotation. Obviously, money's been going into the FANG stocks today: Facebook, Amazon, Microsoft, Apple, and so that maybe that's what's going on here. Is there's a little bit of taking profits in some of the Dow stocks that have had a pretty sharp run over the last week, and putting some money into those beat down NASDAQ 100 names. But here's a chart of the Qs. And so again, is it possible that we do rally all the way back up and join those other indexes? It's always possible. And like I said, things could change, and we could see some momentum start really flying in, where all the indexes start taking off. But I want everyone to pay attention to the fact that trend was broken in the NASDAQ, because it could be that we rally up, go to a new, as soon as this goes to a new high, we get that larger correction, and we can point to that as being kind of a warning sign ahead of that. Because remember, these were the leadership stocks. These were the stocks that led the whole rally from the lows back in what was it, April and May of last year, where we bottomed out somewhere in that time period there. We had the big sell-off and then started to rally off of that. Those were the stocks that kind of led us out. It started with the NASDAQ 100, the FANG stocks, those large cap, the big cap tech stocks, and then it rotated over into the small cap tech stocks. But the tech sector is the one that really led the way. Now, another thing that I look at, I don't have it on the list here, but before I get into the other charts, I pointed this out before, but I like to look at the chip stocks as well. They tend to be a leading indicator of the market. When the chip stocks are really rallying, the market tends to rally. When they're lagging, it's often a warning sign. But you can follow the whole group by using the ticker symbol SMH. It is the Semiconductor Index, or ETF. That you could actually trade the whole sector too. But I mean, this is looking a lot like that NASDAQ 100 chart. The chips have been up for the last couple trading sessions here, but they're still lagging. They're still a little ways away from breaking out. So, and again, they've been rallying on lighter volume, and it looks like today could end up being lighter volume than the last few days as well. So, keep an eye on that. If you start to see these start selling off again, especially in a disproportionate way to the market, meaning they're selling off at a greater rate than the market is, then that could be an indication that the market could be heading in that direction pretty soon. And vice versa. If these end up moving up higher and start to break out, it's probably a good chance that the whole NASDAQ index will end up doing the same. All right. On bonds, the TLT, the bonds are still going lower. They're still trending lower. Let's take the volume bars off so we can see that chart a little bit. Now we're not actually in the extreme oversold range yet, so there is still further this could drop. And I would be willing to bet that bond yields will be moving and probably pretty dramatically based on what the Fed has to say tomorrow. So there could be a little bit of volatility there. They did jump. The bond yields did jump pretty. The 10-year went into the 1.6. I haven't checked it today yet to see where they're trading at right now, but it made a pretty big jump over the weekend, and it'll be interesting to see if it makes a bigger jump from where it is right now. It gets up closer to 2, then the market will probably have a little bit of a freak out over that. So that's something to look for. If it comes all the way back down, gets below 1.5 or so, I think the market will be a little bit more comfortable with rally off of that. Gold is bounced a little bit here, but it's still in the downtrend, and it makes me wonder if this is a little bit of a bearish ABC correction here, if we're not heading lower. The trend is still down. Now, obviously, trends can change, but this is still, as far as right now, this is just looking like a rally within the downtrend. The previous lower high was right here, about 170 on the GLD. So it would have a ways to go to kind of go to that higher high. As far as it's not in the extreme oversold range either. So I mean, it still has ways to go to where it becomes extreme. Now, it doesn't always have to get extreme, but when I look at this and it's still kind of in the middle, in the hold range in the middle there, it tells me that it could drop a lot further from here and still not be oversold. So makes you wonder if that is just a little correction right here for another move down. We'll see. We'll see how these looks next week, but the trend is definitely still down on this one on gold. Oil, the trend is clearly up. This looks like it's in just a little bit of a correction. It's moved a little bit sideways over the last week and a half. And as you know, that's typically, if you want to pay attention, when you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. That's what happened here. Although, keep in mind, this is about a little over 2 weeks, 2.5 weeks where it moves sideways. So, could this be moving sideways for another week before going higher? It's definitely possible. But the trend still looks up, like it's up, and should continue to move up. And we'll assume that until we see different. The dollar is a hard chart to read right now. I think I mentioned this in the last market update. You do have higher high, higher low right here. It could indicate that it's a trend reversal from this downtrend, but it could also be that this is a bearish ABC pattern, wave A, wave B, wave C. In other words, this was a correction of this drop, and we have further to drop. And we did start to move a little bit lower right here off of that, but we moved a little bit lower than we've been kind of flat the last couple of days, and so we're kind of in a no man's land right here. I can't tell. We haven't gone to a lower low. We haven't gone to a lower low right here to break that higher high, higher low behavior, and we've dropped a little bit, but then we've rallied up a little bit, and then we're moving sideways right here. I mean, we could be looking at this next week, and the dollar could have gone to another higher high, looking like it's probably more likely to go up. It could be all the way down here where it's close to going to another lower low and breaking and making it more likely this is just a correction of that downtrend. So, I'd say it's a hard call on the dollar right now. Could really go either way from where it is right now. The key points you want to pay attention to, though, are going to be this previous high right here and this previous low. If we break above or below those, it'll be a stronger indication of trend. So if by next Tuesday we are above this high, it's more likely that the dollar is climbing, that we're maybe in a trend reversal, going from this downtrend into an uptrend. If we're closer, I don't think we'd get below this low by next market update, but if we're closer to that low, if we drop down, we're getting a little bit closer to that low, and we do end up breaking below that low, it'd make it more likely that this was just a correction within the downtrend, and we have a much bigger move down in the dollar. So we'll keep an eye on those two levels. And the VIX has been dropping, and so there's the VIX has dropped far enough now to where it is a bullish sign that the volatility is dropping, because it's telling you that the professional traders aren't too worried. They don't feel the need to hedge. But there's also a contrarian way to view that, especially when you start getting to more dramatic lows in the VIX, that complacency is too low, which means that if there is a jolt to the market, there is a surprise to the market, and it starts selling off, that you've got a lot more room for that fear to build, and you can see a big spike up in the VIX if when you get down to these much lower levels. Because a lot of, again, traders are going to hedge based off of, those professional traders are going to hedge their portfolios based off of concern. They're not going to waste that money if they don't think that they need to spend that money to hedge. And that's the whole, that is the tricky part with the VIX or making those decisions is it's like the decision to buy insurance. Well, you might look at your personal life and say, man, if you add up what you're paying in your homeowner's insurance and your car insurance and your health insurance, you could probably find a million things that you'd rather spend that money on. But it's usually worth it to spend because it gives you the peace of mind. And now, if those rates, insurance premiums that you're paying, if they doubled immediately or soon, you'd have to maybe decide, how much more worry you'd rather have to balance that out. Maybe you lower your coverage on your car insurance a little bit to get a little bit cheaper rate. You don't feel you need as much coverage or something like that. Well, these portfolio managers they're trying to decide whether to buy that protection, that downside protection on the stuff they're holding. And the tricky part is if they wait until the disaster hits, they wait till the market sells off, those premiums on those options become a lot more expensive. We talked about that implied volatility in the training last week, and that a premium increases when that volatility, when that fear or when that drop starts to happen, and so they have to pay more for that protection. And so when it gets down real low right here, what's going on is you're going to have fewer. It's telling you that the portfolio managers are very bullish on the market. They're not worried at all about a drop, which means they're less likely to buy that protection to protect themselves from a drop. So when they're exposed and they're more exposed, and suddenly you have something that freaks the market out, now they've all got to scramble to buy that protection, and that's where you can spike up in the VIX off of that. So I have a tendency, when you start getting really low on the VIX in comparison to where you've been, I start looking at that as a little bit of a contrarian, not too much, because especially if the trend still looks fine and the VIX is still dropping, great. But when we start to add this up to what I've been talking about with the NASDAQ breaking its trend, lagging the other indexes that haven't gone to a new high, lighter volume on the rally over the last week, and the VIX hitting new lows where there's almost no concern about that, it starts to build a recipe for disaster when that happens. Because if something does sell off, it'll basically, it's catching everyone by surprise, and that always fuels the fear of a sell-off, is when they feel like they're caught by surprise. All right. Let's take a look at a couple of stocks here. I'm going to go down to the computer technology. Remember, this is a sector that's lagged a little. The tech sector has lagged a little bit, but some of these stocks are high strength ranked stocks. So if the NASDAQ is going to rally and catch up to the other indexes, this is where you'd see the stocks that are going to make that comeback. And so, and out of those, I'd want to find the ones that are kind of outperforming. I've shown this MVIS one. This is a 100 strength rank here, Microvision, MVIS at the top of the list here. I like this pattern. Again, nice burst of a move right here. This looks like a possible bullish ABC pattern right here. And we're starting to get pretty close to going to that. Let me switch this over to signals here. Getting pretty close to going to the buy signal. And so I still like that one. Another one is, and I think I've gone over this one as well before, is this IZEA 99 strength rank. Kind of a similar pattern. He had a nice big run up here. This had a pullback that went, it's kind of a little bit choppy on the pullback, back and forth. You like to see that. It went to a sell signal. And then what I'd like to start seeing here, and we can watch this as we're waiting for it to go back to a buy. So here's a little bit of a bounce right here that gave you a lower high right here. And then it dropped to a lower low. And so I'd be looking, one of the first clues that this thing could be turning around, going from a downtrend into an uptrend would be, does it start acting like an uptrend? And one of those first signs would be, does it go to a higher high? Does it break above that last lower high and give you a higher high right there? And then on any pullback, you'd want to see if it gives you a higher low. And so those are some little things that I would look for as I'm waiting for it to go back to that buy signal, because obviously you're kind of using the buy signal as the main trigger to get in. But if you can also see some of these little chart behaviors before that signal is triggers, then it'll make it a little bit of a stronger buy signal, if that makes sense. So, all right, let's take a look at. Now these are a couple of smaller companies, and I always have to be careful with some of these, because let's look at the CPSH. I think this was this was fine. This is a NASDAQ. It was the next one it's a over the counter. So it's a really small company, and I got to be careful about when we talk about smaller companies, because you get in a group. I don't know how big the group is that's listening to the update or listen to the recording of the update, and you get a bunch of people jumping in on the same stock, and it's a really small company. You can kind of jack the price up, and you'd be the reason why it's jacking the price up is with everyone kind of jumping in at the same time. So, but this one right here, again, very similar, kind of an ABC correction right here. Look to it. I am a little bit concerned on this little pullback right here. I don't want that to end up going to a lower low. So I wouldn't want it going below this. So particularly since that's a critical low right there, because you had this previous high. Here's a little bit of an ABC, bullish ABC pattern that broke out. Here's a deeper ABC, which is probably correcting the entire move up right here, this larger entire move up. But and it's still possible this isn't done. And this could be in a downtrend. It could go to a lower low, and if it did, I'd probably just stay away from this, because it could be coming all the way back down. But usually there's a reason why a stock has an explosive move, especially if it comes out of a long base like it had right here. Usually there's a reason for that. It could be that it's a rumor or something, and then that rumor changes, or that reason for it rallying changes. But it's not uncommon when we get a big burst like that to get a deeper pullback, but then usually you can get a pretty good run after that. If the story behind that rally, the original rally, was legitimate, then usually it'll continue that upward trend. And I like to find a lot of stocks like that. I don't like to hold them while they're moving sideways for 3 years or something, but I like when they finally break out, because they're moving, and they tend to keep moving at that point. And But again, since you're waiting for this to go back to a buy signal anyway, you'd wait for it to go to a higher high. That'd be another clue there. If it could hold that low right there, it'd give you a higher low. And that'd be something you'd be kind of looking for there. And then the last, actually, we'll do a couple more here. One would be, I think it was this MKTY, I think, 98 strength rank, MKTY, mechanical technology. Let's see if this was it. Yeah, OTC, I'm looking right here, over the counter exchange. So it's not trading on a major index like the New York Stock Exchange or the NASDAQ exchange or the Amex or something like that. So it's really a small company, but it's kind of a similar thing where it's broken out of a range. Had a first move up, pulled back, broke out. Let's have a deeper pullback to the breakout area right here, and now it's rallying back up. This is probably pretty close to getting back to a buy signal too. Yeah, real close. In fact, any move higher is going to put that thing at a buy signal. I also like this CDGE here. CDGE 97 strength rank. Had a big move today that went to a buy signal today. You could wait for it to break, see if it breaks out, because what it did, it opened up at the breakout area right there, but now it's trading lower, so it's trading lower than where it opened, but it's still higher than where it closed the day before. So if you're just looking at, is this stock up or down for the day, it's going to show you, not only is the stock up for the day, but it's up almost 20%. But it doesn't tell the whole story, because this is where it opened up here, and now it's trading lower for the day. So it's lower for the day, higher than where it closed the day before. Usually this is a bearish price action, which means it wouldn't be surprising if it pulls back a little bit from today's move. So a safer entry might just wait to see if this thing can break out to a new high, because if it breaks out to a new high and holds it, then it's probably going to take off again, much like it did. In any of these, see back here, reached a high, pulled back, and then when it broke out again, it took off. Here, when it broke out, that's when it took off again. That's why we like to buy breakouts, as they typically start taking off there. But that's a little bit of a warning for today. I don't know if I'd buy that buy signal or buy in based on that buy signal. All right, one more. We'll get in another sector here, industrial products. And I like this. It's a 96 strength rank, but this XONE, XONE company, very similar. The consolidation that broke out, pulled back. I don't like the way it's trading today, but we're waiting for it to go back to a buy signal anyway. But I do like that longer term pattern there on XONE company. All right, I didn't mention this at the beginning of class, but the trading today is that we're going to kind of put together what we've gone over with options over the last couple of weeks. And so if you missed all those other classes, you're going to want to go back and review those recordings, because today's not going to make a lot of sense to you. But this will be recorded as well, so you'll have a chance to kind of go through all those other trainings and then be able to, but we're going to be I'm going to show you how to kind of go through the process of placing a trade. I'm just logging into my account here, my demo account here. And I'm going to kind of go through, hold on here. Go through how kind of a basic way to select a strike price, an expiration date, things like that. Now, as I mentioned before, one of the trainings I was doing on this, I got a question of can you show us what strike price to choose and all this? I'm going to show you kind of a generic way to start trading options. That's kind of a little bit of a safer way to start. You're going to be modifying that eventually. And it really, to choose a strike price, an expiration date, and all that stuff really depends on your ability to read the chart. Because if you think that stock is going to make a $5 move immediately based on your analysis, then I don't need a lot of time for my option. I might only go out a week for expiration if there are weekly options available on that stock. I might go slightly out of the money on my strike price to get a little bit more leverage and hopefully make a little bit more money on the trade if I'm right about that move. And so you're gonna play. These are not meant to be laws that you have to follow in trading options, and you can't vary from these. You can't deviate from these laws, but it'll at least give you a kind of a standard way to start, and then you can kind of adjust it from there. Now let's take a look at a chart here real quick. Pull up. All right, let's look at just something like Bank of America. And I'm using Bank of America, well, not only because the stock's in an uptrend, but also because these options are a little bit cheaper to trade, and you don't get these usually you don't get big wild moves on Bank of America. So if that way, because the danger in anytime I do an example in class or talk about a stock in class, and I've learned this over the years, is that there's always the person that they don't hear any sort of warning or any sort of words out of my mouth that say this is just a random example. They just hear a ticker symbol and they go run out and buy because Jerry mentioned some stuff. They don't even know what the stock is. They don't even know what they're doing, but because Jerry said it in class, they're running out and buying it. And I'm always afraid of that. So, I try to, just in case, try to find something that if there is someone that just runs out and buys it without that, hopefully they don't get hurt by it. But this stock is in an uptrend, so that has that going for it, and the options are a little bit more inexpensive to where you could trade it with a lot smaller capital. But let's go. So let's pull up the option chain on Bank of America. And again, your broker, I'm not going to be able to coach you based on individual brokers. There's so many. In other words, what I'm showing you right here is TD Ameritrade, and if you're using a different broker, they will have to show you how to pull up the option chain on their platform, and they might have to show you specifically how to place a trade on their platform. But there's a couple of these that are pretty generic for every trade you're getting into. These do have weekly options available on them. You can see here there's a March 19th expiration, which is this Friday. There's a March 26th, which is the next week, April 1st. Actually, that's a Thursday because the market's closed on Good Friday, which is April 2nd. So the rule of thumb on how much time, I used to tell people about 6 to 8 weeks, but that's really too much time. And that used to be because there weren't weekly options available. There were just monthly options available. So you had a March option, an April option to choose from. This was several years ago. This is probably 6 or 7 years ago. And I've been coaching this for a long time, but it used to be that there were only the monthly options available. They all expired on the third Friday of the month, and so it made sense to go out a month and a half to 2 months in time. Now with all the weekly options, it's not very practical to go out that far unless you're really expecting a really big move that you're trying to stay in for a long period of time. The problem with going out too far, though, is that I talked about this last week, is you spend too much time in time value. And most stocks, now it works out great if you have a stock that just goes up and up and up for 3 weeks straight. But how many stocks go up for 3 weeks straight? Not many, right? What typically happens is they go up for a week straight, and then they consolidate for a week, and then they go up, or something like that. They stair step their way up. Well, instead of trying to capture that whole move and go out 2 months where you're going to have dead periods in there that you're just losing money in time decay because you're not going anywhere. So you paid for that additional time and it's not going anywhere. I'd rather try to trade these bursts of a move. So I go out a couple weeks, trade that move, and then wait for it to consolidate again, which it typically will do. And then if you still think it's going to go higher, trade that next burst of a move. And so usually what I recommend going out is about, I would say a good safety would be about 3 to 4 weeks to start off. At least 2 weeks, but I'd say 3 weeks is probably a good, just safe starting point. Now, again, I'm not saying you have to do that forever, but if you don't know how much time you need by looking at the chart based on your chart analysis, that at least gives you a good buffer. And you're not overpaying by going out 2 months or anything like that. So I would probably be looking at, you could probably look at that April 9th expiration there. That's 24 days out, about 3 weeks out. You could even consider that April 1st would be a little over 2 weeks. Let's just go ahead and do the April 9th right here. So I'm going to click this little drop-down box. All I did was click on that plus box and drop down. That shows me my strike prices. Now, most brokers, they're not going to show you all of the strike prices because there's so many of them. And most of the time, you're going to be trading options that are right around where the current stock price is. So the current stock price right now is $37.62. So these would be the strike prices that I'd be considering, right in this area, right in here, right around where that current stock price is. Okay. If you do want to look at all of them, so right now it's set by default to all the options that are near the money, near the current price of the stock. I could change that to all, and it would show me all the different strike prices that there are available. But I'm not going to do that right now, so because we don't need to. So now, as far as the strike price to choose, kind of my rule of thumb is I try to usually have people start with buying the first strike price in the money. Now, an easy way to do it here, so on your calls right here, remember that whole shaded area right here are all the in the money. These are in the money strike prices. So if all you have to do is just look at that first shaded strike price right there, which would be the 37.50 strike price. Now that would also be considered at the money because that is the strike price that's closest to the current stock price. Actually, yeah, that's still the case. You could go a little bit further in the money if you want to get a little bit more equity in the option, a little bit more intrinsic value. It costs you a little bit more. In this case, it costs us $1.49 versus $1.21. But I'll leave that up to you how you want to do that. But I would at least go in the first strike price in the money, so you have some intrinsic value in the option. That's a good, safe way to start. Okay, the out of the money options are cheaper, but they're also riskier because, and especially if you don't know how to gauge how far that stock could go and how fast it could go. How fast you get there. If you don't have those skills down yet, then you're going to go broke buying out of the money options. Because if you buy at the wrong time, if that stock has been going up and you think it's going to keep going up, and you buy an out of the money option right here, and that stock suddenly corrects and moves sideways for 2 weeks, you're gonna get killed. I mean, there's probably almost no chance that stock is going to get above your strike price by expiration, and you're going to lose that money. You know, the old saying that option traders use is, if you trade a lot of out of the money options, you'll soon be out of money. It's a good saying to have in your mind to kind of warn you a little bit not to go for those options that are just because they're cheaper. The probabilities of these working out are much lower. Yeah, but that's the tricky part, though. It entices you because it is cheaper, but it's also riskier, and so you have to kind of weigh that. So these guidelines going to help you protect you a little bit from that. Go in the money, out about 3 to 4 weeks, and so I would choose that one. Now, if I thought Bank of America is going to go down and I wanted to buy a put option, I'd look at the 38 strike right here is the first one that's shaded. These are the shaded. That would be the first in the money option. Cost me $1.35 or $135 for one contract. Okay. Now, before you do any of these with live money, make sure you do them on paper, meaning especially with puts. A lot of people, it takes them a little bit longer to understand how puts work or how they're making money when the stock goes down. Their put option goes up in value when their stock goes down in value. And it'll click a lot easier if you watch it and see it. So do some paper trades, write it on a piece of paper. There used to be, a lot of these brokers used to have virtual trading accounts. I don't know if TD and Ameritrade. There was a broker that Schwab bought out a few years ago. I used to use them for years. It's called Options Express, and they had the best training simulated trading platform I had seen. It was not the most elaborate, but it was the simplest to use. So for beginners, it was perfect. And it was just like doing real trades, and you could put as much money as you want to in your virtual account. And then they got bought out by Schwab, and they did away with that virtual account. And I haven't been able to find a good one since. And but anyway, do some practice trades where you're just watching it, and I do that with the calls as well, because you want to just kind of make sure you kind of understand what you're doing, or understand what's kind of going on before you're risking real money. And then when you do risk real money, do it real small at first. Buy one contract where, you know, if I buy this one contract here, I'm only risking $121, and it's not going to be disastrous if it doesn't work out. That first trade doesn't work out. Okay. All right. Now to pull up the order form. Usually most brokers are like this, where you remember you buy at the ask price. So I could just click right here on the ask price right there, and it'll put, it knows not only the price, but it knows the strike price. It'll put all that information in the order form. Now, back when I first started trading, I had to enter in that information, the strike price, the expiration, onto the order form. And I made so many mistakes when I was in a rush or a hurry in those early days. And sometimes the difference between the ticker symbol for the call and the ticker symbol for the put were one letter or something like that. You had these numbers and letters you had to enter in, these big, huge ticker symbols you had to enter in for the option trades. This was back in 1998, 1999 when I first started trading. But if you changed if you put in the wrong letter, you could be buying the put instead of the call. I mean, it was a disaster. But nowadays it's all kind of computerized. So as soon as you click on that ask price, it automatically fills out the order form. It knows what you're looking to buy, and it knows you want to buy it because you buy at the ask price, you sell at the bid price. Now, you also want to keep an eye on the difference between the ask price and the bid price. I don't know if I mentioned this in the previous trainings, but that's called the BidAsk Spread. And most of the time, if you're trading any of the Dow stocks or pretty much any of the S&P 500 stocks, there might be an exception out there, but typically, and most of the NASDAQ 100 stocks, most of the larger well-known companies, you're not going to have to worry about this. But on really small companies that aren't traded, there's not a lot of trading activity on them, there'll be a wider spread between the bid and the ask, meaning a difference between what you can buy it for and what you can sell it for. Now, this is not bad at all. And in fact, anything under 50 cents is fine. Anything under $1, you get up to 75 cents, 80 cents. The only time I'd be okay with that is if it's a fast-moving stock, because I know the wider spread. So Amazon will have a little bit of a wider spread on those options. You might even have $1 difference in the spread, but it's because it can move. It'll move so fast. It'll overcome that spread price pretty quick. But on some of these really small companies, you might go look at the ask price. If you're not careful, you might just see that the ask price is $3. You might say, oh, let's go get it. But you don't notice that the bid price is $1. What does that mean? Well, that means I'm buying at $3. And if I change my mind, I want to sell it immediately because I didn't like the stock. I was worried it's not going to make the move I thought it was going to make. I can sell it, but I got to sell it for $1. That market maker is not going to buy it. He's going to buy it. He said, I'll be willing to buy it from you, but I'm going to buy it for $1. In other words, that stock, that option, or the stock would have to go up far enough. That stock might go up $3, where that bid price is now $3 or something like. Or let's say the stock has to go up let's say the stock goes up $2, makes a $2 move up. And now that bid price is at $3. Now you're lucky you can get out at break even, and yet the stock made a pretty big move. It made a $2 move, and you didn't make any money because the spread was too wide. Now, it doesn't happen very often, but it happens a lot on really small companies. But you want to pay attention to that. If you see a wide spread, that's not a good sign. Or you better understand what you're getting into. If you still think that stock's going to make a big move and it won't matter, if I think the stock's going to make a $10 move in the next week, okay, I don't worry that there's a $2 difference in the spread, because I still can make money on this thing. But you better be darn sure it's going to make a big move, because you're going to have to overcome that obstacle of that wider spread. And it's just a riskier trade. And usually it's not worth the risk to me. I already have the risk of getting the time right, and the timing right, and the movement, the direction right. I don't need to have another problem in there, because you start to add this up. If your timing isn't right, the direction isn't right, and now you have a risk of a wide spread, you're basically you just need every bit of luck in the world to make money on this trade. It's not worth it at that point. Now, keep in mind that if the option isn't worth it, you can still go buy the stock, okay? And that's what usually happens. If I have too many of these obstacles to overcome, and I don't think it's worth it to get the leverage of the option, then I'll just go buy the stock, and I don't have to worry about time value. I don't have to worry about expiration dates. I don't have to worry about wide bid-ask spreads, because usually they're not that wide on the stock trades. So, but anyway, that's one other thing that you want to at least be aware of and pay attention to is. And most of the time, if you're dealing with the more well-known companies, you're not going to have to worry about it. All right, so we click on that. I'm going to click on the ask price, and it's going to pull up the order form. And I just got to pause this here for a second. Let me pull up the order form here. All right. So here's the ticker symbol. Now, when you click on the ask price, it'll automatically fill that out, because when you click on the ask price, it assumes that you want to buy the option. Now, there are a couple of terms that we need to be aware of on the action right here. Whenever you're buying the option, you're an option buyer, you're going to use buy to open when you get into the trade. And when you sell it, whether it's selling it for a profit or selling it for a loss, you're going to use sell to close. Okay. So make sure that says buy to open. Usually if you click on the ask price, it'll assume you want to buy, and so you're buying to open the position. You can see there's a sell to close down here at the bottom that you would use. Now, if you're shorting, you're an option seller. We're going to be getting into this in the next segment. We're going to talk about being an option seller. You would use sell to open and buy to close when you're an option seller. Okay. So make sure it says buy to open. You also want to make sure that when you place any option order that you always use a limit order. What a limit order means is that I want to buy it at $1.21 or better, but nothing higher than that. So if while I'm taking all this time to fill out the order form, if that price went down to $1.20, then I should get filled. When I place this order, I should get filled at $1.20 because that's a better price than $1.21. If while I was playing around here and placing this order, that option went up to $1.22, it's not going to fill my order because I put a limit on how much I wanted to pay on that. The reason why that's important is sometimes these things can move very quickly. And especially if you don't get filled right away. It could be that that this thing moved up to $1.22, or let's say I put in a market order. It could be that while I was putting in that market order, some news came out. I didn't know about the news, and the stock jumped, and suddenly that option is $2.50 because it jumped so fast. Maybe more than that. It could be like $4 or something. I'm thinking I'm paying $1.21, and I end up paying $4 for it because I gave permission to. Market orders, you're saying whatever you want to charge me. And people do that sometimes because they want to get filled on the order right away. They'll just use a market order, and that's a good way to get burned. They always use a limit order, and usually by default it'll put in there as a limit order. When I clicked on that ask price, it automatically put in buy to open and automatically put in a limit order. But I could change it if I wanted to, and it put in the last price it was trading at right there, assuming I wanted to get in at that price or better. Okay, and then and then you can hit review the order right here, and it'll go over it'll show you how much it's going to cost with the $121 plus the commissions. And some brokers are not going to have commissions, and so that'll be good. You don't have commissions, but so that's how much it'll cost. And then you just place the order. Which I'm not going to do at this time. All right. Now let me go back to the option chain here. And I got to wrap things up. I got to hurry on this. Now, there's not a very big spread here. There's the ask price. Here's the bid price. Sometimes what you can do is you can see if you can get a little bit better deal. I might say, see if the floor trader, I could put in a limit order. The ask price is $1.23. I could put a limit order in at $1.22 and just see if that market maker is willing to give me a little bit cheaper price, willing to give me a little bit of a discount on the spread there. Now, sometimes what will happen is you'll put in a little bit cheaper price and the stock will move down just a little bit and it'll trigger it based on that cheap price. But sometimes you'll get a floor trader that's like, that's close enough. I'll fill that order and you save a penny, and I get that's not a lot, but if you're trading like 20 or 30 contracts or something, that can add up. That could pay for any commissions or even give you a little bit of a profit to start off with because you got a little bit, or give you a profit sooner because you got in a little bit better price. It depends on how much time you want to spend on it. Most of the time I'm trying to get in right away And so if I'm trying to fill a big order, like 20 or 30 contracts or 50 contracts, yeah, I try to get in a little bit in the spread if I can to get filled on that bigger order, because I'm actually going to be creating. Sometimes what can happen if you're trying to buy too many contracts and it's more than the market could absorb, you could end up jacking the price up on yourself. Meaning, if I put in an order to buy 30 contracts, then he might fill 10 contracts at $1.22, but then the price goes up, and you say, okay, you got partially filled on your order. The ask price is now $1.24 or something like that, and then I got to make a decision. Do I want to chase it? Do I want to get filled on the next 10 contracts at $1.24? See, the price is going up. I'm making the price go up because I'm trying to buy more than the market can absorb. Now, you're not going to have that problem if you're buying 1 or 2 or 3 or 4 contracts or something like that. But if you're trying to buy 20 or 30, you're probably not going to get filled at the same price for all those. So you have to be patient. You have to kind of wait. If you're really going to be a stickler for the price, I got to wait to get partially filled at $1.22. Wait until maybe that gets back down to $1.22 again before I try to get filled on the rest of my order. Or you got to chase it, and you don't want to get in the habit of chasing it, because you're jacking the price up on yourself, and unless you're expecting a really big move right away, that could be detrimental. All right, I'm going to end it right there. On Thursday, we're going to get into talking about being an option seller, and I'm going to focus a little bit more on put option selling. Those of you that are longer term trader or investors are going to love that class, because it's going to be one of your favorite ways to buy stocks. Get paid to buy stocks. How would you like to get paid to buy a stock that you already want to buy? Well, I'm going to show you how you can do that starting on Thursday. We might get through the full class on Thursday, but over the next couple classes, we'll cover that and talk about being an option seller. All right, thanks everyone. Have a great week. See you on Thursday. Bye now.